Let's dive into the differences between ETFs and ETNs. ETN stands for Exchange Traded Note. ETNs are debt securities issued by financial institutions. They promise to track an index's performance. Unlike ETFs, ETNs don't own the underlying assets. They represent a promise of payment from the issuer. Understanding these differences is key to making informed decisions. Now, let's take a deep dive into their structure. Let's break down the anatomy of an ETN. Imagine you purchase an ETN tied to the performance of gold. Instead of owning physical gold bars, you're essentially lending money to the ETN issuer, typically a large financial institution. This institution promises to pay you a return based on how well gold performs over a specific period. This promise of payment is where ETNs differ significantly from ETFs. While an ETF gives you direct ownership of the underlying assets, an ETN is a debt obligation. It's like an IOU from the issuing bank. Your return is directly tied to the issuer's ability to honor that promise. Now, you might be wondering, why would I choose an ETN over a physically backed gold ETF? This is where the unique features of ETNs come into play. They often offer exposure to markets and investment strategies that are difficult to access through traditional ETFs. Additionally, ETNs can provide potential tax advantages, which we'll explore in the next section. However, this debt-based structure also introduces a new layer of risk: credit risk. If the issuing institution were to face financial trouble, your investment could be at risk. This risk is absent in traditional ETFs, where your investment is secured by the fund's underlying assets. Understanding the structure of ETNs is crucial. It enables you to weigh the potential benefits against the inherent risks. This knowledge will help you determine if ETNs align with your investment goals and risk tolerance. Section 3. The allure of ETNs and ETFs. Unveiling the advantages. ETNs and ETFs each offer unique advantages that attract investors. For ETNs, one of their most significant benefits is tax efficiency. Unlike traditional ETFs, where capital gains distributions are taxed annually, ETNs generally only realize capital gains when you sell your note. This tax deferral can be a significant advantage for investors seeking to minimize their tax liabilities. Another key advantage of ETNs lies in their ability to provide access to niche markets. Think of commodities, currencies, or complex investment strategies. ETNs can track these specialized markets with remarkable precision. They offer investors exposure that might be difficult or even impossible to achieve through traditional ETFs. For instance, imagine you want to invest in the performance of a basket of African currencies. Finding an ETF that tracks this specific market might be challenging. However, an ETN could easily be structured to track this unique index. This accessibility opens up a world of investment possibilities for those seeking to diversify beyond traditional asset classes. Moreover, ETNs often come with lower expense ratios compared to actively managed mutual funds. This lower cost can translate into higher net returns for investors over the long term. This cost-effectiveness makes ETNs an attractive option for cost-conscious investors seeking to maximize their investment returns. On the other hand, ETFs offer their own set of advantages. They are generally more transparent, with holdings disclosed daily, and they provide instant diversification across a wide range of assets. ETFs are also typically more liquid, allowing for easier buying and selling on the open market. If you found this guide helpful, make sure to subscribe to our channel for more smart investing tips and insights. Don't forget to hit the notification bell so you never miss an update.